Question 1. An insured in Florida has a life insurance policy with a 14-day free look period. If the insured decides to return the policy during this period, what is the insurer obligated to do? A. Return the premium paid minus a surrender charge. B. Return the premium paid, but only after 30 days. C. Return the entire premium paid with no surrender charge. D. Issue a new policy with different terms. Answer: C. Return the entire premium paid with no surrender charge. The free look provision, also known as the right to examine, allows a policy owner to return a new life insurance policy for a full refund of the premium paid within a specific timeframe after delivery, typically 14 days in Florida. This period gives the policy owner time to review the policy terms and conditions without financial penalty. If the policy is returned during this window, the insurer must refund all premiums paid, emphasizing the consumer protection aspect of this important provision. Remember, the free look period is designed to protect consumers by allowing them to review the policy without commitment. Question 2. Which of the following statements best describes the purpose of the incontestability clause in a life insurance policy? A. It prevents the insurer from denying a claim due to suicide after a certain period. B. It allows the insurer to contest a claim at any time if fraud is discovered. C. It prevents the insurer from denying a claim based on misrepresentations in the application after the policy has been in force for a specific period. D. It guarantees the policy will never lapse due to non-payment of premiums. Answer: C. It prevents the insurer from denying a claim based on misrepresentations in the application after the policy has been in force for a specific period. The incontestability clause is a crucial provision in life insurance policies that protects beneficiaries from delays or denials of claims. After a policy has been in force for a specified period, typically 2 years in most states, the insurer cannot contest the validity of the policy due to material misrepresentations, concealments, or fraud by the insured in the application. This clause is designed to provide security and peace of mind to the policy owner, ensuring that their beneficiaries will receive the death benefit without endless investigation into past application details. Think of it as a statute of limitations for the insurer to discover application inaccuracies. Question 3. All of the following are typically considered non-forfeiture options in a whole life insurance policy, except A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. Automatic premium loan. Answer: D. Automatic premium loan. Non-forfeiture options are provisions that allow a policy owner to receive some value from a cash value life insurance policy if they stop paying premiums. The 3 standard non-forfeiture options are cash surrender value, extended term, and reduced paid-up insurance, which provide different ways to utilize the accumulated cash value. An automatic premium loan, while a policy provision that uses cash value, is not a non-forfeiture option. Instead, it is a loan provision that prevents a policy from lapsing by automatically borrowing from the cash value to pay an overdue premium. Always remember that non-forfeiture options are about stopping premium payments and still getting some value, whereas an automatic premium loan helps keep the policy in force. Question 4. What is the primary characteristic that distinguishes whole life insurance from term life insurance? A. Whole life policies offer higher death benefits for the same premium. B. Whole life policies build cash value and provide coverage for the insured's entire life. C. Term life policies offer the option to borrow against the policy's value. D. Term life policies always have level premiums for the life of the policy. Answer: B. Whole life policies build cash value and provide coverage for the insured's entire life. The fundamental difference between whole life and term life insurance lies in their duration and cash value accumulation. Whole life insurance provides lifelong coverage, to age 100 or 121, and accumulates a cash value that the policy owner can access through loans or withdrawals. In contrast, term life insurance provides coverage for a specific period, the term, and does not build cash value. This cash value component is a key feature of whole life insurance, offering both a death benefit and a living benefit. Think of whole life as permanent protection with a savings component, while term is temporary protection without savings. Question 5. The period during which Social Security benefits are not payable to the surviving spouse of a deceased worker, typically between the youngest child reaching 16 and the spouse reaching age 60, is known as the A. Elimination period. B. Benefit suspension period. C. Blackout period. D. Waiting period. Answer: C. Blackout period. The blackout period refers to the time frame during which a surviving spouse, who is caring for the deceased worker's dependent child, does not receive Social Security survivor benefits. This period starts when the youngest child reaches age 16, or age 18 if still in high school, and ends when the surviving spouse reaches age 60. This gap in income can create a significant financial challenge for families, which is why life insurance planning often considers this specific period. Understanding the blackout period helps agents recommend appropriate life insurance coverage to bridge this potential financial gap for beneficiaries. Question 6. A life insurance policy's grace period typically allows the policy owner how much time to pay a premium past its due date before the policy lapses. A. 7 days. B. 10 days. C. 31 days. D. 60 days. Answer: C. 31 days. The grace period is a crucial provision in life insurance policies that allows a policy owner an extended period, usually 31 days, to pay an overdue premium without the policy lapsing. During this time, the policy remains in full force, and if the insured dies during the grace period, the death benefit will still be paid, minus the overdue premium. This provision is designed to prevent unintentional policy lapses due to a slight delay in premium payment. It's a safety net for policy owners, ensuring continuous coverage even if a payment is slightly late. Question 7. Which life insurance rider pays a monthly income benefit to the insured if they become totally and permanently disabled? A. Accidental death benefit rider. B. Waiver of premium rider. C. Cost of living rider. D. Disability income rider. Answer: D. Disability income rider. The disability income rider is an optional addition to a life insurance policy that provides a monthly income benefit to the insured if they become totally and permanently disabled. Unlike the waiver of premium rider, which only waives future premiums, this rider actually pays out a specified income to help replace lost earnings during disability. This rider offers an important living benefit, ensuring financial stability for the insured during a time when they may be unable to work. It's a valuable addition for those concerned about loss of income due to long-term disability. Question 8. In Florida, what is the maximum amount the Florida Life and Health Insurance Guaranty Association will pay for the cash surrender value of a single life insurance policy? A. $100,000. B. $250,000. C. $300,000. D. $500,000. Answer: A. $100,000. The Florida Life and Health Insurance Guaranty Association is a statutory entity that protects policy owners in the event an authorized insurance company becomes insolvent. For the cash surrender value of a single life insurance policy, the association provides coverage up to a maximum of $100,000. It's important for policy owners to know these limits, as the Guaranty Association is a safety net, but it doesn't cover unlimited amounts. Remember, this protection exists to provide a degree of financial security when an insurer fails. Question 9. Which settlement option in a life insurance policy pays out the death benefit in a lump sum, but only after the beneficiary provides proof of regular attendance at a specified educational institution? A. Interest-only option. B. Fixed amount option. C. Fixed period option. D. this is not a standard settlement option. Answer, D, this is not a standard settlement option. Life insurance settlement options provide different ways for beneficiaries to receive the death benefit, such as a lump sum, interest only, fixed period, or fixed amount. The options are designed to provide financial flexibility to the beneficiary. There is no standard settlement option that requires proof of educational attendance for a lump sum payment. While a policy owner might attach specific instructions or create a trust to manage funds for educational purposes, the settlement options themselves do not inherently include such conditions. Always distinguish between standard policy provisions and more complex estate planning tools. Question 10. A life insurance policy's suicide clause typically states that if the insured commits suicide within how many years of the policy's effective date, the insurer will only return the premiums paid. A. 6 months. B. 1 year. C. 2 years. D. 5 years. Answer, C. 2 years. The suicide clause is a common provision in life insurance policies designed to protect the insurer from individuals purchasing coverage with the intent of self-harm. This clause typically states that if the insured commits suicide within 2 years of the policy's issue date, the insurer will not pay the death benefit but will instead refund the premiums paid. After this 2-year period, the suicide clause no longer applies, and the full death benefit would be paid. This provision balances the need for protection against fraud with the broader purpose of life insurance. Question 11. Which type of life insurance allows the policy owner to vary the amount of premium payments and the face amount of coverage? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer, C. Universal life. Universal life insurance is a flexible type of permanent life insurance that offers adjustable premiums and adjustable death benefits. Policy owners can increase or decrease their premium payments within certain limits, and they can also adjust the death benefit, which makes it highly adaptable to changing financial needs. This flexibility is a key differentiating factor from traditional whole life insurance, which has fixed premiums and a fixed death benefit. Think of universal life as offering more control over both contributions and coverage. Question 12. If a policy owner assigns their life insurance policy to a bank as collateral for a loan, what type of assignment has occurred? A. Absolute assignment. B. Collateral assignment. C. Irrevocable assignment. D. Testamentary assignment. Answer, B. Collateral assignment. A collateral assignment of a life insurance policy means that the policy is pledged as security for a debt. In this scenario, the policy owner retains all rights of ownership, but the creditor, the bank, has a temporary claim on the death benefit, only to the extent of the outstanding loan balance. Once the loan is repaid, the bank's interest in the policy ceases. This differs from an absolute assignment, where all ownership rights are permanently transferred to another party. Collateral assignments are common when a policy is used to secure a loan. Question 13. Which of the following is true regarding the taxation of life insurance death benefits paid to a named beneficiary? A. They are generally subject to federal income tax. B. They are generally subject to state income tax. C. They are generally received income tax-free by the beneficiary. D. They are only taxable if the policy's cash value exceeds the death benefit. Answer, C. They are generally received income tax-free by the beneficiary. One of the most significant advantages of life insurance is the income tax treatment of the death benefit. When a death benefit is paid to a named beneficiary upon the insured's death, it is generally received income tax-free at the federal level. This means the full face amount of the policy goes directly to the beneficiaries without being reduced by income taxes. This tax-favored treatment makes life insurance an extremely effective tool for providing financial security to loved ones. Remember, income tax-free does not mean estate tax-free, but for most beneficiaries, the death benefit is a tax-free windfall. Question 14. What is the primary purpose of the Notice Regarding Replacement form in Florida life insurance transactions? A. To inform the applicant that the new policy is more expensive. B. To require the applicant to undergo a medical examination. C. To advise the applicant to compare the existing policy with the proposed new policy and consider potential disadvantages of replacement. D. To waive the free look period for the new policy. Answer: C. To advise the applicant to compare the existing policy with the proposed new policy and consider potential disadvantages of replacement. The Notice Regarding Replacement is a crucial regulatory document in Florida, and in many other states, designed to protect consumers when they are considering replacing an existing life insurance policy with a new one. Its primary purpose is to inform the applicant about the potential risks and disadvantages associated with replacement, such as new contestability periods, loss of favorable policy provisions, and new surrender charges. This form ensures that the applicant makes an informed decision by prompting them to carefully compare their current policy against the proposed new one. Always ensure this notice is properly provided and explained to protect your clients and comply with regulations. Question 15. A beneficiary designation that states, "to my children," equally, would typically be interpreted as which type of designation? A. Per stirpes. B. Per capita. C. Contingent. D. Irrevocable. Answer: B. Per capita. A per capita beneficiary designation means, by the head or by the person. In this type of designation, the death benefit is distributed equally among the named or designated living beneficiaries. If one of the named beneficiaries predeceases the insured, their share is divided among the remaining living beneficiaries. In contrast, per stirpes, by the branch, would pass the deceased beneficiary's share down to their heirs. When "to my children" equally is used, it implies that each living child receives an equal share. Question 16. The policy provision that allows a lapsed life insurance policy to be put back in force, provided certain conditions are met, is known as the A. Grace period. B. Non-forfeiture option. C. Reinstatement provision. D. Automatic premium loan. Answer: C. Reinstatement provision. The reinstatement provision allows a policy owner to reactivate a life insurance policy that has lapsed due to non-payment of premiums. To reinstate, the policy owner typically must pay all overdue premiums plus interest, provide evidence of insurability, and repay any policy loans with interest. This provision usually has a time limit, often 3 or 5 years from the lapse date. It's a valuable option for policy owners who wish to regain their original policy's benefits, such as the original issue age and cash value. Question 17. Which of the following is true regarding a variable life insurance policy? A. Its cash value and death benefit are guaranteed. B. Its cash value fluctuates based on the performance of a separate account. C. It is regulated solely by state insurance departments. D. It has a fixed premium that never changes. Answer: B. Its cash value fluctuates based on the performance of a separate account. Variable life insurance is a type of permanent life insurance where the cash value is invested in a separate account, typically managed by the insurer and invested in stocks, bonds, or other equities chosen by the policy owner. Because the cash value is tied to investment performance, it is not guaranteed and can fluctuate, potentially increasing or decreasing. Due to this investment component, variable life products are regulated as securities by the SEC in addition to state insurance departments, requiring agents to hold both a life insurance license and a securities license. Always remember that variable means risk and potential for growth, tied to investment performance. Question 18. What is the standard free look period for an annuity contract in Florida? A. 7 days. B. 10 days. C. 14 days. D. 21 days. Answer: C. 14 days. Similar to life insurance policies, annuity contracts in Florida also have a free look period, which is typically 14 days. This provision allows the contract owner to examine the annuity contract after delivery and, if dissatisfied for any reason, return it to the insurer for a full refund of all premiums paid. This consumer protection measure ensures that individuals have sufficient time to review the complex terms and conditions of their annuity purchase without financial penalty. Always inform clients about this important right, ensuring they feel comfortable with their purchase. Question 19. An insured misstated her age on a life insurance application, claiming to be younger than she actually was. If this is discovered after her death, how will the insurer handle the claim? A. The policy will be voided, and no death benefit will be paid. B. The death benefit will be reduced to the amount that the premium would have purchased at her correct age. C. The death benefit will be increased, as she paid premiums for a longer period. D. The insurer will pay the full death benefit, as misstatement of age is not a valid reason to deny a claim. Answer: B. The death benefit will be reduced to the amount that the premium would have purchased at her correct age. The misstatement of age or sex provision in a life insurance policy states that if the insured's age or sex was misstated on the application, the insurer will adjust the death benefit rather than void the policy. The death benefit will be adjusted to the amount that the premium paid would have purchased at the correct age or sex. This ensures fairness, as premiums are based on age and sex, and it prevents either party from gaining an unfair advantage due to an error. This clause prevents policy voidance while ensuring actuarial accuracy. Question 20. Which of the following best describes the purpose of a waiver of premium rider? A. It pays a lump sum benefit if the insured dies in an accident. B. It increases the policy's cash value over time. C. It waives the policy premiums if the insured becomes totally and permanently disabled. D. It allows the policy owner to withdraw cash from the policy without penalty. Answer: C. It waives the policy premiums if the insured becomes totally and permanently disabled. The waiver of premium rider is an extremely valuable addition to a life insurance policy. Its primary purpose is to ensure that the policy remains in force even if the insured becomes totally and permanently disabled and can no longer pay premiums. Under this rider, after a waiting period, typically 6 months, the insurer will waive all future premiums for the duration of the disability, protecting the policy's continued coverage and cash value growth. This rider safeguards the policy in the face of unforeseen disability, providing peace of mind. Question 21. Which dividend option allows the policy owner to use policy dividends to purchase additional small single premium policies that increase the overall death benefit and cash value? A. Cash payment. B. Reduction of premium. C. Accumulate at interest. D. Paid-up additions. Answer: D. Paid-up additions. Life insurance policy dividends are a return of excess premium and are not guaranteed. The paid-up additions dividend option allows the policy owner to use these dividends to purchase small, single premium whole life policies at the insured's attained age. Each small policy has its own cash value and death benefit, which adds to the existing policy's values. This option allows the policy's death benefit and cash value to grow over time without further premium payments from the policy owner, making it a popular choice for increasing coverage. Question 22. Group life insurance policies typically offer a conversion privilege. What does this privilege allow an individual to do? A. Convert their group coverage to a higher amount of group coverage without evidence of insurability. B. Convert their group coverage to an individual policy without evidence of insurability if they leave the group. C. Convert their individual policy to a group policy upon joining an employer. D. Convert their term life insurance to a whole life policy within the group plan. Answer: B. Convert their group coverage to an individual policy without evidence of insurability if they leave the group. The conversion privilege is a crucial feature of group life insurance. It allows an individual who is leaving the group, e.g., due to job termination or retirement, to convert their group coverage into an individual life insurance policy without needing to provide evidence of insurability. This ensures that individuals who may no longer be healthy enough to qualify for a new policy can maintain coverage. This privilege is generally available for a limited time, typically 31 days after leaving the group. Question 23. An annuity payout option that guarantees payments for a specific number of years, whether the annuitant lives or dies, is known as A. Straight life income. B. Life income with period certain. C. Joint and survivor income. D. Fixed amount installment. Answer: B. Life income with period certain. The life income with period certain annuity payout option provides income payments to the annuitant for their entire lifetime, guaranteeing that payments will continue for a specified minimum period, the period certain, such as 10 or 20 years, even if the annuitant dies sooner. If the annuitant dies before the period certain ends, the remaining payments for that period will be paid to a designated beneficiary. This option combines lifetime income with a guarantee against premature death. Question 24. What is the primary purpose of the Florida replacement rule concerning life insurance? A. To ensure that all new life insurance policies are issued with a 14-day free look period. B. To require all agents to be licensed in Florida before selling life insurance. C. To protect consumers from unfair replacement practices by requiring full disclosure and comparison of existing and proposed policies. D. To prevent insurers from charging surrender fees on existing policies. Answer: C. To protect consumers from unfair replacement practices by requiring full disclosure and comparison of existing and proposed policies. The Florida Replacement Rule is a comprehensive set of regulations designed to protect consumers when they are considering replacing an existing life insurance or annuity contract with a new one. Its core purpose is to ensure that consumers are fully informed about the potential advantages and disadvantages of such a transaction, particularly the loss of benefits or higher costs associated with the new policy. This rule mandates specific disclosures and procedures to prevent agents from engaging in practices that might be detrimental to the policy owner. Question 25. Which of the following is an example of an unfair trade practice related to life insurance advertising in Florida? A. Stating the guaranteed interest rate on a fixed annuity. B. Using terms like investment, profit, or return on investment to describe life insurance policies that do not function as securities. C. Highlighting the tax-free nature of life insurance death benefits. D. Providing illustrations that show potential future values based on current assumptions. Answer: B. Using terms like investment, profit, or return on investment to describe life insurance policies that do not function as securities. In Florida, and most other states, insurance regulations strictly prohibit misleading advertising. Using terms such as investment, profit, or return on investment, when referring to non-variable life insurance policies, like whole life or universal life, can be considered an unfair trade practice because these policies are primarily insurance products, not investment vehicles, and their cash value growth is different from typical investment returns. This practice could mislead consumers into believing they are purchasing a stock or bond, rather than an insurance product. Agents must accurately represent the nature of life insurance products to avoid misrepresentation.